Hey guys, Dennis Shapiro here with the October edition of the SIH Capital monthly webinar series. Really excited here that not only is one of the guests that we're speaking with today is one of my business partners, but Jared is also one of my advisors on mobile home parks. So between both of them, they play a huge role in almost everything that I do from a day-to-day perspective. There isn't a mobile home park deal that I look at as a limited partner that I don't consult either Jared or Fabio or both of them. So I kind of wanted to get them on here to kind of introduce you to the community. I met Fabio first at the Mid-Atlantic Conference in Philadelphia. Ironically enough, he was on a list to go out in North Jersey for a mobile home park to a meetup. And on the first day that he invites me to come out there, the speaker was actually Jared. So Jared gave his presentation. We ended up talking, I think, probably 2-3 hours and 4 espressos later. That is a common theme between me, Fabio, and Jared. We probably drink I just had like 2 right before the webinar, but we probably average a good 3-4 espressos a day. And so I am a big fan of the way Jared does business. One thing about him that's been super fascinating is a lot of people that got into the space kind of took a boot camp, went out, and then just started buying parks, and they more or less don't know what they're doing. They learn on the job. I feel like Jared has kind of done it the right way. He inherited the park. He didn't inherit. He actually bought his parents out their mobile home park. So he's actually one of the only true second generation operators that I've ever come across with. And he's my age, which is even more impressive. And then the other thing that I always find interesting with Jared is that he actually doesn't raise money. So it's refreshingly honest, because usually when raising money, there's an element of marketing to it. But when you're an operator yourself and you're not raising anybody else's capital, you can actually be 100% genuine, which is I've always found really refreshing about my relationship with Jared, which is approaching probably about 3-4 years at this point. Fabio, a little bit about Fabio. Me and Fabio actually met at a Mid-Atlantic Conference, and the funny part was that we walked across each other probably a good 20-25 times and never really spoke. And then we briefly were like, well, we keep crossing paths, we should talk. And then we actually ended up exchanging emails. And I always email almost everybody that I meet at a conference. Fabio actually took it up and we started talking consistently. He was in North Jersey. I was in Central New Jersey. We started going to some meetups together. We started networking with some people together. And then about a year ago, actually a little bit more than a year ago, we started working together on a project that some of you guys might be familiar with, the Surf Village at Bradley Beach. He's one of the 3 operators besides me on that project. But besides that, he's actually been building up in a pretty impressive mobile home park portfolio. And the only reason why he's not on video today is that he's actually coming back from an acquisition that he's recently did. He's doing the onboarding today. So without further say, I'm going to introduce first Fabio. I'll let you say anything that wasn't covered by that brief intro. We'll send it over to Jared, and then we'll get into the questions.
Sure. I mean, that pretty much covers it. We just closed on our 3rd park on Friday, which the whole portfolio is in South Jersey. And yeah, I'll let first of all, honored to be on the panel. I'm nowhere near Jared's level, but I'm honored to be invited as a speaker alongside Jared.
Thanks, Fabio. And thanks, Dennis. Yeah, thanks for including me. This is pretty cool. And you did a good introduction. I think one theme you'll see, I'm very specialized. I, at this point, only do manufactured housing. I had a few little things. I helped my family who had some other types of investments, such as single tenant net lease types of properties. I had some apartments. Those are all gone. I've really just buried myself in this. So sometimes that might be helpful for some of these questions, and it also might not be helpful for other questions that they relate to comparisons, but we'll have some fun.
Yeah, and I'll say this, the interesting part is kind of, well, a lot of my thinking besides this panel is Fabio is exclusively New Jersey and Jared is exclusively Pennsylvania. Those are two markets that are not usually associated with when you're in the syndication space, especially as an investor. You hear nothing but Texas, North Carolina, Florida, and it is really interesting to see the perspective of investors that are actually super specialized, super focused, and actually do it in their backyard. And what that allows us to do is it actually allows us, even though Fabio and Jared don't actually have investors, it actually allows, like for us, when we do our projects in Pennsylvania and Jersey, to actually bring out our investors to come out to the actual property, get that connection versus just getting a monthly report and not having that feel for what you're actually invested in and such. So without that, I did want to mention that how hyper local they are to just Pennsylvania. And then probably, Jared, what is your whole portfolio is within what, a 50-mile range? Or
I had the one property that was out in Erie. That was a 6-hour drive. That kind of informed a bit of my management style, but now everything is within the Allentown, Bethlehem, Easton market. Maybe an hour max end to end.
And Fabio, how geographically diverse is your portfolio? Mobile home parks.
They're all in South Jersey. They're within 40, 50 miles of each other. I mean, there's one that's 40 miles away and the other two are 4 miles apart. And we're actually just got under contract another park that's a few miles away from that as well.
So what I wanted to get at is this isn't one of those situations where sometimes you get a bigger mobile home park funds, and there's a couple of big ones. I don't want to throw out any names, and they cover almost the entire United States. So it's really interesting to see such focus. And I know another operator in New York, in upstate New York, who has a similar kind of focus. And there's some uniqueness when you get into talking and understanding the expertise that actually comes along with knowing your councilman, knowing the local environmental rules, and knowing everything to such a level that these guys know of their own local areas. So I just wanted to mention that really quickly before our first question. You guys ready for it? All right. So Fabio, I know you can't see, so we'll start off with you on this. Is it true that you can't invest locally if you live in a high cost state?
Definitely not. New Jersey in particular, and I'm sure it's like this every state. There's, high cost markets, there's low cost markets. It's just a matter of finding, what works for you.
Jared, what about you?
I agree with what Fabio said. This is a business, and so you pick and choose. Your strategy is going to look different. What the market returns you can expect are going to look different. You kind of want to know, based on the market that you're in, it's going to determine the game that you're playing, the business that you're running, and that's going to determine what your work looks like. It should also determine what your returns look like. So I don't see, and again, speaking predominantly from one market at this point, paid as high as maybe 80,000 a unit, just as a rule of thumb. And to me, it makes a lot of sense.
And it's interesting when you come across investors that are dealing out of state, you kind of almost get unit envy, because they're like, oh, we just bought a 300 lot park for what you just paid, a 36 lot park. Do you ever come across that, and like how does that make you guys feel when you see those high unit numbers?
It's all it doesn't matter, the unit count, because it's all relevant. Because a 300 unit park where you're getting $250 lot rents is the equivalent to a 100 unit park where you're getting $750 lot rents. So you have to take it all into context and figure out what you're actually looking at.
What about you, Jared?
There's fluff. There's the smoke and mirrors people put up, like unit count. something like that. These are just rules of thumb. You know, you have to get down to the substance. If you're in this, you're in it to make money. You're in it to get a good return. That should be the question. And to add to what Fabio said, in fact, I would actually prefer fewer units if we're going to keep other things the same, such as the total revenue, because that is an indicator that the housing market's stronger. Right. And so what that also tells me, an important thing to keep in mind in the manufactured housing space is that the homes don't get more expensive. They're shipped from a factory. So now you should have a bigger margin when you're selling these homes. It should be easier to sell these homes. And I would argue that makes the investment that much more attractive. So if you're getting the same cap rate in a high cost per unit market and a low cost per unit market, I would probably be going with the high cost per unit market. I won't be able to tout a big unit count, but I'll be much happier.
Nice. Okay, so so I guess the next follow-up question is, we determined that you can definitely invest local even if you're in a high cost area. What is your best piece of advice to someone who is looking locally in a high cost area? Jared, I'll give you this one first.
Advice for getting started, for finding a deal, or you have a deal and advice for running it?
No, I'd say like finding a deal in a high cost area, because then you add on the top of the brokers. Let's put it the brokers premium, right? Mm-hmm. And it gets very, very hard to do a deal in most cases. So what would you advise someone who's local? And maybe this could kind of tap into some of your past experiences of how you source deals, but yes. What's your best piece of advice of finding a good deal in a high cost area?
Got it. I think there's a lot of, especially those guys who invest everywhere. People are really smart and people are really hungry, much smarter. Remember that they're probably smarter than all of us, and they're hungrier than all of us. Certainly hungrier and smarter than I am. We need all the benefit. We need all the edges that we can get. And I think if you're looking locally, you have an edge, because the folks who are looking all over the nation, they cannot go with such a fine-tooth comb that you can go locally. So my experience has been through networking. My strategy wasn't originally to stay in one market. It sort of evolved and I've grown to appreciate it, but it was because I was able to get quality deals. And those have come from my lawyer, having the same lawyer as the seller, having the same sewage treatment plant operator as the seller, stopping in and visiting folks. And I think that those things pay off. So I would say that use the fact that you are looking in your backyard to do what the folks who are calling in from across the country can't do. And relationships are really important. And the properties you want to get are probably being sold by long-term owners, probably 10, 20, 30 years, or their children. And they'll typically value those relationships. So you have that as an advantage. Use it.
Yeah.
Fabio, what about you?
It was a great points. I would say, just in addition to that, consistency, knowing the ins and outs of your market, and knowing what areas up and coming that maybe the data that somebody else who isn't local is going to necessarily see, and speed. Just like Jerry said, being able to hop over if you're whatever, less than a couple hours drive from a market and a deal comes up, you can get there and look at it and get eyes on it, get a feel for it. You can see stuff that the numbers aren't necessarily going to show, and that's going to give you the advantage.
Fabio, it's a good point. I'm glad you kind of got a little bit more into the nitty gritty, like talking about the speed. I think there's maybe some sort of general things, but if you're working with local banks, can be they can be hit or miss. Each local bank, the smaller it is, the more unique their investment appetite is. I found a local bank, one branch bank, I think the owner at some point was involved with manufactured housing. Now we have this relationship that I do most of my deals with that bank, and that helps. As Fabio said, quickness counts, and that helps me be quick because I know exactly what they're looking for. I know exactly what they'll give me. So there's a lot more depth into just meeting the sellers. You establish your network in there, your professional network.
And I would also kind of tap onto that it's interesting when you do talk to a local seller, once you get out of the whole broker middleman, but if you actually get a hold of the local seller and they can hear that you don't have an accent, they can hear that you're not just some out-of-state investor that's looking to shake them down, that goes a long way. I remember, Jared, I think we actually spoke about this because at one point me and Fabio were doing some cold calling, sellers, and you're like, that's not going to work in my area because the moment they hear your New York accent, you're dead in the water. And I think you're dead on. And it's about having that local flavor that helps build that credibility quicker. So that's all I wanted to throw onto that. So my next question is about landlord friendly versus tenant friendly. Both, I would say, Pennsylvania is a blue state. New Jersey is one of the bluer states. How do you guys approach tenant landlord rules being in a somewhat blue state? I know Allentown is probably a little bit more in the middle, but just wanted your take on, because that's a big hindrance. You talk to anybody who's an investor in New Jersey and they want to stay local, especially New York. New York, I don't even want to touch. But New Jersey and Pennsylvania, how do you guys deal with tenant landlord rules? How have you guys found it in terms of evicting someone in the mobile home park space, stuff like that? So I think, Jared, you answered the last question first. Fabio, why don't you do this one first?
Sorry, guys. My recommendation here is just make sure you have an awesome attorney who is an expert in your specified area of real estate. So we have our attorneys on the board of the New Jersey Manufactured Housing Association. And she's a rock star. And then part of that is also just aligning your expectations. I mean, know that this is not Texas. You're not going to get a tenant out in 30 days. Could take 6 months, could take 18 months, but eventually you'll get them out. Just is what it is.
Jared, what about you?
That's a good point, Fabio. Yeah, no matter what state you're in, probably consider joining the State Association for Manufactured Housing. Just a wealth of knowledge. I think Pennsylvania, politically, it's considered purple. It's gone red and blue. I think actually, I would argue that Pennsylvania is also is tenant fair, landlord fair. There are states that make Pennsylvania look landlord friendly. Maybe compared to New York. There's some states that make it look tenant friendly. So a huge thing in Pennsylvania, for example, we can't end somebody's lease. If we just can't pick up and end somebody a tenant's lease. There are many states where you can do that. And we need them to not pay or to not follow, to break the rules twice within 6 months. I think that's fair, actually, because there is a huge expense to the tenant if the landlord could whimsically end their lease. And so I think we'll get, I know that I saw the questions that are coming up. You sent them out a little bit ago, and part of my management philosophy is you should be treating people how you want to be treated. And maybe sounds cliche, but if you're not trying to shortcut and you're not in a rush and then it really shouldn't be a problem long term. If you have a long-term focus, it shouldn't be a problem. In fact, again, it probably helps because a lot of the states you mentioned where there's a lot of startup funds and boot campers who have exploded, they're going to places where it's sort of the Wild West in favor of the landlord. So you've got that competition. There's other examples where it actually, I'd say, helps if you're looking for long-term stability. the cost to install a home in Pennsylvania and a lot of the northern states, but in Pennsylvania, for example, at this point, a single wide is $15,000. I mean, it sort of depends on what you're counting in that installation. But what that stops is the tenant stealing game. So this is some regulations that are heavy duty. It's not the Wild West. It's not the freest of markets, so to say. But I've talked personally to operators who are in wars, paying tenants thousands of dollars to move their home because there's no real moving cost to speak of. And to me, that's not good for a long-term business. I don't want to operate in that. I don't think if you're looking for stability and passive income, you want to operate in that. So I don't have any problems with some of these tenant protections.
So just to add on to that, so I do think Pennsylvania is like, we have a property in Pennsylvania, and as long as you're outside of Philadelphia, because Philadelphia is very, very tenant friendly. But once you get outside of Philadelphia, usually it becomes actually surprisingly very, very tenant, I would say landlord, I would say fair. You know, it's not like I think in our property in Oxford, we're evicting people. It probably takes like 3 weeks. It's not like in Texas where you could go in and steal their flat screen TV if they're not paying for it. So I think it's definitely fair. But I think you hit on a really good point, is that sometimes these regulations, if you understand them, you could actually gain them to become a competitive edge. And I think this is something, I know we're supposed to be talking about mobile home parks, but this is something me and Fabio are coming across with the short-term rental space, where the town that we are operating in are looking to pass ordinances, and we are just looking to manage those ordinances. And as long as they pass after we're in there, we could use that as a competitive advantage, because now you're not going to get a wave of more short-term rentals there. So that's actually like perfect for us. So you could almost use it if you understand it, and if you're not being passive about what regulations are being passed, and have a voice and make sure that you are, making sure that your voice is out there, then you could really, really use it as a competitive advantage. The second point that I want to hit on with what you said is, when you're dealing with getting a deal from a broker, and then they're showing you the pro forma, and they're showing you year one an aggressive rent bump, and you are turning around and you the LP investor or the potential buyer of that park, you actually have to evaluate how tenant landlord rules are going to affect that 1 year magical bump up. Because a broker is not going to explain to you how difficult it is to evict someone in that place, or even if it's possible to evict someone. Because Jared was describing good cause evictions, where basically someone has to do something wrong. So that also means you can't just bump up their rent to a certain extent or whatever it is. So understanding the rent regulations in the area that you're getting these offerings, because 9 out of 10 times the brokers will, I don't want to say use the word mislead, but they will make it seem a lot easier to execute a business plan where tenant turnover is involved. Let's just put it that way. And I think understanding that is a critical part as an investor, and that's on the investor. It's not on anybody else. And if you're getting pitched a deal on a different JV, or someone else is bringing you a deal, it is the investor's job to understand some of that. And that's where it does help, where if you're a New Jersey investor, the fact that you understand, and you might have a couple of single family rentals, you'll kind of understand, wait, something is wrong. It's not that easy to evict in New Jersey, and you're expecting complete tenant turnover in year one. So I think that's a really, really critical point that I wanted to make, coming from what you guys are mentioning. You guys want to jump on that, or move on to the next question?
All right. Yeah, I think it adds to there's kind of a pro and a con, and I think that's it. You're kind of what you're hitting on. There's a pro and a con. You got to choose, do you like this game? Because you get some protections from it as well.
Yeah, great point. So next question, this is an interesting one. Property management. Now, this is something that from a limited partnership side, I always looked at. The reason why I always looked at it is because 9 out of 10 deals that I've gone bad on me, or I've gone bad on an investor that I know, the number one reason they would blame is property management. Number one reason. So what do you guys let's go with Jared. What is your philosophy on property management? I kind of know the answer, but let's get your take on it. First party, third party property management. What are some of the culture that you try to bring in to property management? Let me hear it, Jared.
I've used the third party property manager before, but I think what I was looking for wasn't out there, and I ended up building it for myself, and that's what my work is these days. So it's not third party, but I'm building the management product that I've wanted, that I got to see as a hands-on mom and pop operation. I saw kind of, what you lost out on with third party. So I'm trying to build my ideal management, but my management philosophy generally is pretty long-term. It's generally pretty conservative, and I was mentioning the golden rule, as they call it, treating people how you'd like to be treated. It's really not. It kind of sounds cliche, but I would say that it's not necessary. It doesn't have to be an altruistic approach. It's that if you take a long-term, usually when you're taking a steady path and you really are really trying to treat residents, trying to treat everyone you deal with the way that you'd like to be treated, a lot of times there might be a short-term profitability opportunity that you miss out on. But I would argue that long-term, it is more profitable. I would also argue that the longer-term management outlook, you can weather a lot more storms, because this is affordable housing. There's no reason to believe that the demand for this is going to disappear. So position yourself long-term, not planning for an immediate exit or a 3-year exit where you're looking at interest rate risks. You're looking at so many risks you can't even account for them all. So I'd say it's quality over quantity, long-term approach.
So Fabio, before I jump into your answer on that one, so a couple of quick questions, Jared, from what you just said, because I don't want to forget them. What was the major difference that you saw from mom and pop operator to that large third party? Because that large third party was like one of the biggest in the country, right? So what was the biggest difference you saw between the two?
Third party, you do much less work. It's like hitting singles, which is you can hit singles. I'm not saying there's anything wrong with that. You're hitting singles. You're getting passing grades on your property. But maybe it's some of my control issues, but I think I wanted higher quality tenant relations, just more profitability on home sales. I wanted to get the juice out of my the lemon. So that was my preference. So I don't think you can get that. I think that there's just some trade-offs that I saw at that scale. So yeah, I work more than a lot more because I'm hands-on with my management. That I think is the biggest difference.
Got it. Okay, Fabio. Jared, I do have another question for you afterwards, but I want Fabio's take on property management.
So we self-manage, and we're kind of going through some growing pains right now where we're starting to become not as mom and pop, a little bit more professional. But I think at the end of the day, your tenants respond to people who care. And a third party property management company, how much they care or finding one that actually cares is very unlikely. And walking through the park that we just acquired today with the sellers, maybe they were a little bit too much on the extreme where they cared too much. They had too much of a good relationship with their tenants, but every single tenant I met told me how much they love living in this community. And a big part of that is because they care. And as a more modern day, owner, operator, manager, it's your job to balance being streamlined, being efficient, managing the P&L and squeezing the juice, while also caring about your community, caring about your tenants, and making sure that you are doing the right thing long term, and maximizing the value not just for yourself but for your residents as well.
Got it. So Jared, this is kind of to Jared. Great answer, Fabio. This is the second question I have for you, Jared. You had talked about long-term perspective versus short-term, and doing things to sometimes sacrificing the short-term gains in order to achieve a more sustainable long-term gains. Like, kind of reminds me almost in that stock market where, the CEOs live and die by the quarterly reports kind of situation. In the investor community, in the syndication space, and I know you don't raise capital, right? But for the people who are on this call that are LPs or are GPs, what would you say to them in terms of when they're talking to the operators to find out what kind of perspective that they have versus are they looking to pop those short-term gains and try to get out of that property? Because right now in 2022, that no longer works. That probably worked in 18, that worked in 19 just fine, that worked in 20, that quick pop, you get your 30% IRRs, and you post it all over LinkedIn of how amazing you are. You've seen, I'm sure, a couple dozen of that. Today, 2022, completely different, right? It is about that long-term perspective, and it's going to be about an extended time period with lower IRRs. And how does an investor today speak to an operator and figure out if it's someone that's stuck in that short-term mindset and that just is going to be looking to get out in 2 years, which may not happen with the interest rates being what they are, or someone that can extend that deal and show that empathy to their tenants, but at the same time produce a good solid return in the long run?
That's a great question. I'd want to brainstorm some, but a few things come to mind. For me, a lot of it is just it starts to become apparent in their assumptions. Of course, asking when they're showing an IRR, what is their exit? What year is that an exit? And what is their exit cap rate? More operationally, though, I would want to know about their infill plan. Specifically, how are they financing it? How are they planning to sell those homes? Are they planning to do rentals? Are they planning to do rent to owns? A hallmark I've seen of the quick flippers, the people who say, look, I'm going to get the numbers big and I'm going to sell it. It's like a bum rush to get those numbers up, which is part of the plan. As Fabio, I would bet that the park that Fabio was, his new park that he was just meeting the new residents, I would bet that they've been there on average more than 10 years. Most of my tenants, I think the average is like 13 or higher years. There's a lot of stability and there's a lot of management benefit. And I think there's a lot of long-term ROI benefit. And again, if you're sharp and you can do a quick turnaround, that's great. If the wind's in your sails and the market's helping you out. But if you want to sort of future-proof that investment, I would be looking at their exit strategies for these homes, how they're going to infill, and is this a quick, if they're thinking longer term, they should be looking for more stable tenants, people who are, able to qualify for a loan and buy it from them. This is one thing that just kind of popped into my head. I would just continuously question their assumptions. It's hard to hide.
Which assumptions would you focus on? You want to come back to it?
Yeah.
Hold
yeah,
on.
it's a
I'll
good
get
question.
Fabio.
Fabio, I'm curious if you have any ideas.
Fabio, are you there?
Sorry, that's what was that. Sorry, the service is cutting in and out.
So,
What was
so
the
I guess
thinking
question?
go ahead, Jared.
thinking about how to sniff out an operator who is really relying on a short-term exit and assumptions, particular assumptions that you could question that would help any LP who's trying to get a feel for the thinking of a potential deal sponsor.
I mean, honestly, other than if it sounds too good to be true, it probably is. And
Yeah.
I don't know. I mean, I'd love to say it's just experience level, but I've never invested it as an LP in a deal. And I just try to think of my own deals as a reference point. And if I were to pitch, I mean, even Bradley Beach, but we're way ahead of timeline on that. But even the mobile home park, that was a huge turnaround last year. If I pitched as an LP, we're a full year ahead of where we thought we would be. So I can't say experience, and that was our first mobile home park turnaround. So I can't say experience is necessarily an indicator, but if people are not, if they're just not conservative in their numbers and it seems fishy, it probably is. I would have undersold, what we would have tried to do. It's just like anything else, under promise, over deliver. If someone's over promising from the get-go, that's a red flag.
Yeah, I think to really go into depth, it would be you can research, and these are pretty easily accessible. How to flip a mobile home park. You can start to sniff those. This is kind of sound silly, but so many of the people, there's like a standard playbook when they're going to say, I'm going to put in white vinyl fencing and put up a new sign. I know where they got that. I think that anybody who's interested long-term, that means that they're planning to stay with the property. That means they're going to be staying in bed with the residents. You got to remember, if somebody is not moving their home, if the average tenancy is 13 years, you care who that person is. So the more that they're focusing on tenant quality and the process of getting new tenants tells me that they're interested in staying long-term. Because any mom and pop that I know, the most hands-on operators that they might only have one or two communities, but they get every drop of juice. They have, like Fabio said, tenants who just love them. They will pass up on a good resident. I'm sorry, on a profitable home sale, if they think that resident is going to give them any sort of trouble. That is just like a hallmark of somebody who's in this business long-term. It's about the lot rent and it's about that long-term.
We're going through that right now with our home sales. I mean, I could care less if they're making a full price offer. If their background story doesn't check out and they sound sketchy, I mean, that's our headache for forever potentially. Not not just for the short term. So you got to be really careful. The other thing I would add to vetting an LP and an aggressive business plan is just ask how and keep asking how and who. I mean, for us, for how we operate, we got super lucky and just have an amazing partner who knows how to do infill and can source homes like nobody else can do. If some operator, new operator says they're going to turn on a park and do 5-6 infills a year, ask them how they're going to do that. Where are they going to find their homes? If they tell you Facebook Marketplace and how they're going to fix them, they say they're going to find a contract, then they don't have shit lined up and they're not going to meet their timeline, not even close. So if you just dig into the details, usually LPs who are full of it will give you, answers that are just what they are, surface level answers without any real thought into the details of how they're actually going to execute.
This is getting the juices flowing. So, and I want to get specific. I gather you're trying to get some specifics, Dennis. So, for example, if their strategy is filling it in with used homes, which is usually a requirement, but often a requirement in softer markets with lower average home sale prices. And they say that they say that they'll be able to infill 5 a year, 10 a year into a community, whatever it is. That the next question that Fabio said, how are you going to do that, is a big one. And what you need to know that you might not otherwise know is that bringing in used homes is one of perhaps is the most grind, is the biggest grind in this industry, to be able to source a used home, transport it, set it up on site. And the reason why it's not scalable, because you can't just, you can call a factory and order 20 homes a year, but to get used homes, you have to go home by home by home. The next thing is it's a mess, because until you're ready to move the home, which could take weeks, or if you're moving quickly, you're paying lot rent where the used home is. You're dealing with, if that's on a community, you're dealing with them. You're piecemealing a mover, somebody who would break the home down, which might be different from the truck that pulls up, delivers the home. Then these homes, presumably you're buying them because you can't, it's the market requires you to have a low cost home, which means you're paying very little, which means this is an old home. So now you're transporting an old home down the road. The old home down the road incurs damage. You get on site and now you have to repair an old home. Older homes are harder to repair because they used to use non-standard sizing on doors, windows, and everything. So it's almost expected that, I mean, to have, no matter, even if you bought a used home for $1,000, which already is a hard thing to find, you're going to be into it for at least $25,000, $30,000 when you have it set up and ready to sell. You got to ask yourself, and realistically, that's probably more today. There's been a lot of inflation. So this is a grind, and I've seen so many people start and fail at this miserably and pull their hair out. So if they say that, it's not that people don't do it, but that means they've got an established operation. So they should be able to point to communities where they've done this repeatedly. They need a team. If they're an operator who's small and they're saying they're going to do this in-house, I would be shocked if I don't know anybody who would say that twice. They'd have to have a team out there. They'd have to have a rehab team. And for that, they'd have to be doing it at scale. So somebody who's making the used homes part of their strategy, I've seen it, and I've seen it in states where they're not required to install. And then doing due diligence, this is like in the Midwest, doing the due diligence, I saw that they were putting up ads that say you don't have to pay a security deposit. You don't have to pay your first month's rent. You could just move in. When I inspected their accounts receivables, they were about 30% delinquency, but their occupancy shot up and their rent roll shot up.
No, it was a great point. Fabio had to jump off. He just wants to say thanks for everybody to be on. He was in the car. I think he was going through a dead zone. I want to switch it over. If any of our guests have any questions, just type it into the chat. I'll get into it. If no one does, I'm gonna go back to one of the other questions that we had, but I didn't want to open it up at this point because we have about 12 minutes left. The other thing that I want to say, like an assumption and variable to look at, if you want to kind of distinguish if you have a short-term minded operator or a long-term minded operator, see how the profit margin is split, see how much money they're putting in the deal themselves. Because if they're not putting in any money themselves, the only way they'll really get their profit is at the sale. So that's going to incentivize them maybe to sell a little earlier than they have to, because that's how they're going to get their 30%, of the profits. The other thing that, look out for is the financing involved. If you got a bridge 2-3 year debt right now, that thing is literally a ticking time bomb. And that's an operator that was looking to come in and do a quick flip and potentially get out or whatever the situation is. So look at stuff like that as well. And, the other thing, like Fabio said, just keep asking. Sometimes sometimes LPs will literally see the presentation and be like, okay, here, let me know when to wire the check. Versus sometimes you need to ask around the questions, especially the first time of investing, then ask another round of questions. And what ends up happening usually, if you end up asking 1 or 2 rounds of questions, most of the time, an operator that's looking for quick money and kind of like the dumb investor money, they'll stop responding to you because they don't want to deal with it. They would rather, they answered your questions kind of, and that's how they want to leave it off. So you want to be sure that, put some thought into the questions, really deep dive into the infills and everything like that was Jared was kind of mentioning. And then, ask them for like a more detailed breakdown of how exactly are you supposed to be infilling, or if it's not infilling, how exactly are you going to be evicting 6 tenants in a good cause state? All of those things are good questions, and they should be asked. You do want to be careful as an LP not to ask 20 rounds of questions, because then it gets to a point where it seems like you're a tire kicker. But 1 or 2 rounds of really well thought out questions, there's absolutely nothing wrong with that. Let me see if there's any questions so far. All right, so let me ask the next question. This might be our last question if no one else has any questions. All right, let me see. Okay, this one's a good one. So how do you see the interest rate hikes and inflation increases affecting the mobile home park industry as of October 2022? I just want to date it because we're in a very special environment right now. But in terms of the deals you're underwriting right now, Jared, in terms of the deals you're looking at, how is that affecting you? How are you also adjusting the increased rent lot increases that you would have done probably pre-2022, and what you're looking to do now across the board?
Yes, good question. I wish I had a crystal ball. But what I can see, I want to, as a reminder, I find that there's safety in a long-term approach. So what I try to do is focus on value, which for me, it's real estate. So location. The safety is in the housing value. If there is long-term growth in that area, the interest rates are short-term. They're going to go up, they're going to go down, they're going to go up, they're going to go down. So this is an area where the market, the price of any property is going to be set by the market. And I think right now people are looking for places for their money. So it seems to me that it's a tough time to predict, but cap rates are still pretty low. I think what that's doing is it's actually cooling it down in a good way. I think smaller operators, the more aggressive, perhaps the too aggressive operators are having to calm down a little bit. I think the other side of it is the people who can keep staying are larger entities that have more complex capital structures, lower cost of capital. And where I'm trying to fit into this is just being strategic. Again, it's not that I love my market. I'm not married to my market. If I thought that long-term there's growth in a market and I could get quality deals and I have the same benefits, then I'm not that concerned about the interest rate. So yeah, long-term.
So you're not seeing much. It's interesting in the apartment building space, there's definitely a big slowdown right now in terms of deals getting done and deals getting repriced down. So it's interesting that you're saying that in the mobile home park space, you're not really seeing that.
My understanding is it is cooling down and the prices are coming down, but to me, they're still really expensive. I think I paid more than I want to pay less every time, I guess, but it was hard for me to pay what I paid, like the $80,000 per pad. It was hard for me to pay. The only way that I could justify it was saying, in 20 years, where's this going to be? And I felt it was a no-brainer there. I like the ride from here to there, even though the next couple of years it might be a little bit tight. Part of the reason why they have $80,000 price per pads in this area is because you can get interest-only debt So, you can kind of take care of your cash flow, your return on your cash on cash for the next couple of years. But again, it's longer term, where are you going to be? If I'm planning to sell in 5 years, I'm sweating. 3 years, I'm sweating.
So, okay, I guess the second part of the question, I kind of find it even more interesting. How are you approaching rent increases this year with this environment?
Yeah, sorry, I forgot to answer that part of the question. Rent increases is also something that is set by the market. When we do rent increases with property managers, I'm going over with them. Look, we've got to understand our cost of operation, and our cost of operation might be going up due to inflation. But at the end of the day, that doesn't, just because our cost of operation goes up, that doesn't mean that we can raise the rent anywhere. If we want to remain competitive, we've got to stay within the market. I think if you're doing your job, if you're doing C level work, your expenses should be in line with the market. And so Pennsylvania, for example, has something that other states, not all states have, which is you can't, no matter what your lease says, even if it's month to month, you can't raise the rent more than once per year. So what I said, I do have to sit with for a year. But again, I'm trying to stay competitive within the market. You'll see, this actually brings me back to your previous question about how to sniff out long-term and short-term holders. The short-term hold has no problem putting their rent above market. And it comes back to the tenant quality. Because if the rent is above market, why would somebody apply to live there in that community? The reason why is because they won't get approved at the community with the lower rent. So if you're a short-term flip, you don't mind. You got a criminal background, it doesn't matter. You have poor history of payments, doesn't matter. As long as you'll be in here for a short period of time, you'll bump up our rent roll. So again, I'm still trying to stay competitive and keep my tenant quality steady, because that's going to remain steady long-term.
So right now, you're not looking around the market and seeing, 15, 20% rent increases in your market?
15 or 20. I don't have the percentage. We have, it's maybe 2 months ago, we completed our sort of market study. The rent raises did grow nominally compared to what the average, there was a time when it was $10 a year, it would go up. For this area, that was common. 20, yeah, and I've seen some 25, some 30s, and there's some outliers usually that have been acquired where they'll do 50 or 100. So I'll take that into account and basically say, how can I remain competitive? How high can I push it to stay within market and but still remain competitive? A lot of times the more aggressive operators, the out of states, they'll push the rent so high that it creates a nice pocket for me to move into, because I'm running a better product, and they've just pushed the rent ceiling so high. So now I can kind of come comfortably into that, where I can say, hey, we're significantly at least $50, $100, $200 below them, but we're property managers who care.
Gotcha. Is there like a sweet spot you try to go to maximize the revenue, but stay under a certain amount of the rent leaders, market rent leaders?
Good question. I don't think I can give you an answer. I don't have a high certainty level. I think I'm still kind of a novice on this, but I try to think about things such as you got to adjust for amenities. So sometimes there's like a gym and a pool and a big clubhouse. For something like that, I want to keep, if I'm just a no frills, like you've got a yard and that's it. I want to keep, at least in my head, it's about 200 to 250, because I think there's a lot of people who will say, I'd rather save 250. I'm not going to use the pool. I'm not going to use the clubhouse or the gym. So I kind of use that as a padding there. I'd say that would be, I guess, the rule of thumb. I don't want to, because when people are coming into the market, they're gonna see that, they're gonna see these big amenities. So I want to stay safely away from there. There's usually some mom and pops in a market that are way below. They're like the outliers on the bottom. Typically, it's because they've been in it. They have no mortgages. They've been in it 30 years. They paid off their mortgage. They've become too friendly with their residents, in my opinion. So they say, hey, our cash flow is good, and we're not gonna push the rent. So you have to take that into account as well. And as usual, somewhere in the middle is a good place to be.
Gotcha. Okay. And then I guess this would be the final question of the night. When we underwrite deals, right, we like to hit that 13 to 15% return like profile, right? You don't have investors. So when you underwrite a deal, what return profile are you looking for in order to align yourself with that longer buy and hold philosophy that you have?
I think an important question to ask is 13 to 15. You said I'm sorry, did you say an IRR?
Yeah, let's say 13 to 15% IRR annual return.
Okay. So because to get in a calculation for an IRR, you have to have an exit. You have to have some sort of recap event. Because I'm so long term, if I'm just doing this personally, I won't put it in. I'll be looking at basically cash on cash, and I'm focusing on around year 5. So it's a little bit different than when you're from being an LP. But I typically want to see, well, it market rate, man, it changes. Right now, the market, I had to accept stuff at like 10% by year 3, cash on cash. But I thought it was a wonderful property. I'd say that there's this Warren Buffett quote. I try to align myself with his way of looking at things. But he said, don't try to pay a wonderful price for a fair mobile home park.
Yeah.
Try to pay a fair price for a wonderful mobile home park. But right now, a fair price is really high. And so, that's fine. But over long term, it's a wonderful mobile home park because of its location, its tenant quality, basically those things. It's in, the asset quality and its competitiveness. And that is going to, it's a simple approach. I think you get much more granular, but I kind of have this simplistic approach. But long term, that's just going to pay greater returns, both that are showing up on the P&L, but I think also management and stability wise, which I think any income you get, you have to qualify it by what's the peace of mind that's attached to it. Is this something you don't know if it's coming or going, and you have headaches and there's lawsuits? That money, those dollars are not the same as the dollars that are coming in that you're sleeping and it's rolling. So market, the market's going to determine what's a fair price. You just have to determine what's a wonderful property.
That's a good nugget right there. And honestly, 10% cash on cash in year 3 is excellent. So it's not shabby.
No, it's not. It's been hard for me to scale. I did have when I first got started, I was looking at like, do I want to scale this? Do I want to take investors? And to find a wonderful property where you are getting that has been hard. It's not been so it's not been the cash, it's been the properties. But that's why I have a measly unit count, as you said, compared to the to the guys who yeah.
All right, Jared, I appreciate your time. I think we ran over by 3 months. I really enjoyed this conversation. Definitely have a bunch of questions we could do a follow-up call with. Why don't you just mention briefly where they can reach you if they want to connect with you?
Sure. Well, the company's website is valleycommunitymanagement.com, all spelled out. And you can just email me directly, Jared, Jared, at valleycommunitymanagement.com. I hope it was useful to some folks, and I enjoy being useful. So if I didn't answer a question that you had, just send it to me. I'd love to help.
You got it. And anybody could just reach out to me. I'll be more than happy to connect you guys with Jared. He's a wealth of resource, and for 4 years I've known him, and I've only learned from him every conversation that we've ever had. So thanks, Jared, for always helping out, and look forward to catching up soon.
Yeah, likewise. Thank you so much.
Have a good night.